Today I want to take a look at the gap. The gap is trading at $38.48 a share and has recently been in the news for showing poorer net income and EPS performance as expected. Now, when we look at the gap, when we look at modeling out the revenue and the cash flows, a couple things we notice is one, first of all, the revenue growth is quite low. It was 3.2% in 2013, lowered to 1.8% in 2014, and I think the street and everyone kind of estimates that this is going to be a trend, this low revenue growth. As with a lot of companies in the retail industry, margins are thin, but however, in this situation, their margins have been relatively stable. And if you look at the cash flow of the business, they are producing about $1.5 billion in unleveraged free cash flow per year, growing at 1.8%. So when you look at that and you discount the cash flow at a balanced weighted average cost of capital, it does look like that their stock is either appropriately priced or there is room for the stock to increase. Now, I always mention that the discounted cash flow analysis is only one thing you want to look for in valuation. And GAAP is a good example of that because I believe that despite the cash being produced by the business, the one thing that might be overshadowing the idea that the cash flows aren't supporting the stock valuation is the general idea that the intangible assets of GAAP, the brand, the clothing, I believe people are getting tired of it, and I believe it's their lack of future positive expectations of their brand that is putting this discounted valuation into their share price. If you run a conservative analysis, their stock, technically, according to the discounted cash flow, could be trading upwards of $50, $47 to $50. Even running different scenarios, their stock price could be trading at $47 to $50. But I do believe it's the investors' lack of positive expectations of the future life of the brand that is bringing the stock price down. And that's one thing that I would say one should be careful of. But what this does mean is there have been situations in the past where even though the intangible assets are waning, the value of the cash flows are still high and stable. The margins are high and stable. These are great buyout opportunities. So what I would watch for is the potential for GAAP to be a buyout target, either by a savvy group of private equity investors or by another company that might find the cash being produced by the business and a lot of their other assets of the business to be of benefit to that company. So it'll be interesting to see what's going to happen with this company and what their next future earnings releases are going to produce, unless the company has some sort of initiative to really turn around the growth of the business. But I think a lot of people agree that they don't see that happening. So if anybody has any questions, please send me an email or you can find me at the New York School of Finance.